Have you ever heard words like stocks, ETFs, mutual funds, dividends, and instantly zoned out? Yeah, I used to feel the same way. But what if I told you these investing terms isn't just for the rich or finance geeks? It isn't exclusive, but is for anyone ready to make their money actually work. So, if you've ever felt left out, this video is for you. You might think investing is a modern thing, but it's been around long before stock markets and Wall Street. It began in ancient Mesopotamia, where merchants pooled money to fund trade expeditions. If the journey succeeded, the profits were shared, and if not, the losses were shared too. This early form of investing was all about sharing risk for potential reward. Back in ancient Rome and Greece, investing looked a little different, but the idea was the same. Wealthy citizens would put their money into local businesses or public projects, like roads or aqueducts, in return for a share of the profits. It wasn't just about personal gain, but it helped the entire communities grow. Investing back then was as much about building the future as it was about making money. The real turning point came in the 1600s, when the Dutch East India Company became the first to issue shares to the public. This allowed everyday people to buy small pieces of a company, marking the birth of the modern stock market in Amsterdam. Over the next centuries, investing became more structured but also more volatile. The South Sea bubble of 1720, for example, showed how speculation could create massive crashes. Still, the idea of investing continued to grow. In 1792, brokers met under a buttonwood tree in New York to create what would become the New York Stock Exchange. Fast forward to the 20th century, and investing finally stepped out of the hands of the wealthy elite and into the hands of regular people. People like teachers, shop owners, young professionals suddenly had access to the markets. Thanks to things like mutual funds and index funds, investing became more affordable and less risky. It wasn't just for the rich anymore. It was for everyone ready to make their money work. So, what actually is investing? Imagine you plant a tree in a small pot, watching it grow day after day, but it only grows just a little. That's kind of like keeping your money in a regular savings account. Now, picture moving that same tree into a wide-open garden with sunlight, fresh air, and space to stretch. You begin to notice the plant blossom into a big tree over time. You're giving your money room to grow through investments like stocks, real estate, or funds, and even letting it reward you in return instead of your money sitting idle in a savings account losing its buying power over time. That's what investing is. Investing simply means purchasing assets with the aim they'll either increase in value or generate income over time. It gives your money the chance to outpace inflation and opens the door to long-term wealth. All right, so you're ready to dip your toes into investing, but what exactly can you invest in? Think of this as your starter pack, the essentials to get you going without being overwhelmed. We're talking about things like stocks, ETFs, mutual funds, real estate, and even bonds. Each one has its own purpose, and together, they can help you build a solid, balanced portfolio. Let's break it down. 1. Stocks. Stocks are like tiny pieces of a company you can own. When you buy a stock, you're basically buying a small share of that business. If the company grows and makes money, your stock could go up in value, allowing you earn a bit of that profit. Sure, stocks can offer great long-term growth, but let's be real, there's risk involved too. That's why smart investors don't put all their eggs in one basket. Instead, they spread their money across different companies, purchasing different stocks in different sectors. 2. Exchange-traded funds. ETFs are investment funds that hold a collection of assets like stocks, bonds, or commodities, and they trade on stock exchanges just like individual stocks. When you buy an ETF, you're buying a small piece of every asset in that fund, giving you instant diversification. This helps reduce risk compared to investing in a single stock. ETFs are popular for beginners because they have low fees, are easy to buy and sell, and often track popular indexes like the S&P 500. They can be a smart, hands-off way to invest in a broad market or specific sectors, like tech or energy. 3. Mutual funds. They are professionally managed investment funds that pool money from many investors to buy a mix of stocks, bonds, or other assets. Instead of choosing individual investments yourself, a fund manager does it for you based on the fund's goals. This offers built-in diversification and is ideal for beginners who want a more hands-off approach. While they often have higher fees than ETFs, they can be great for long-term goals like retirement. 4. Let's talk real estate. Because investing isn't just about stocks and numbers on a screen, real estate investing involves buying physical properties like houses, apartments, or commercial buildings with the goal of earning income or profit. You can make money through rental income or property appreciation when the value of your asset goes up. Although real estate offers tangible assets and could act as an hedge against inflation, it, however, requires more capital, time, and management. And that's where real estate investment trusts come in. Real estate investment trusts are companies that own or operate real estate like apartments, office buildings, malls, or warehouses. When you invest in them, you're buying shares in that company, giving you exposure to real estate without owning physical property. They are traded on stock exchanges like regular stocks and often pay out high dividends, making them attractive for income-focused investors. They are a great way for beginners to invest in real estate with low capital and high diversification. Plus, they can be an easy way to add real estate to your portfolio without being a landlord. 5. Bonds. With bonds, you agree to lend your money to a government, city, or company at an agreed interest rate for a certain amount of time. In return, they agree to pay you interest for a certain amount of time in addition to the original value of the bond. They are considered safer than stocks, making them a popular choice for conservative investors or for those closer to retirement. Common types include government bonds, like U.S. Treasury bonds, municipal bonds, and corporate bonds. While returns are usually lower than stocks, bonds offer stability and are a key part of a diversified investment strategy. So now that you know what investing is and the basic instruments to investing, how do you start? Let's walk you through it, step by step. Number 1. You need to clean up your finances. Pay off high-interest debt like credit cards and build a little emergency fund. Saving aside 3 to 6 months of expenses is ideal. 2. Set your goals. Write down what are you investing for. Is it for retirement or a down payment or income generation, or just to grow your wealth? Also, decide how long before you would need this money, as that will help to shape your plan. 3. Know your risk appetite. Can you handle the market going up and down? How old are you? If you're young, can you take more risk? And if you are much older, do you have enough time to bounce back in case something goes wrong? 4. Decide on which of the 5 mentioned investment instruments you would like to start with. Weigh their pros and cons. Make sure it aligns with your goals, risks appetite, and present situation. 5. Pick an investment platform. There are numerous apps out there. Apps like Robinhood are easy for stock trading. Providers like Vanguard can be awesome for index funds and ETFs. Fidelity or Charles Schwab are solid, reputable choices with great customer support. Just go with one you are comfortable with after you have done a thorough research about them. 6. Start small and stay consistent. Even $10 a month is a start. You can even use something called dollar cost averaging by investing the same amount regularly, no matter what the market is doing. It smooths out the ups and downs. And here's something important. Do not skip learning. Seriously, take the time to understand what you're doing. Books like The Simple Path to Wealth by J.L. Collins is a total game changer for beginners. They break things down in a way that just clicks. And when the market dips, which it will, do not freak out. Take a breath, trust your plan, and only adjust if it truly makes sense. Remember that patience is part of the process. Excited to get started? We'd love to hear from you. What's your favorite way to invest? Or what are you most curious about? Drop it in the comments. And if you found this helpful, do not forget to like, share, and subscribe for more. Until next time, keep learning, keep growing, and go make your financial dream a reality. See you next time.